Welcome back to your ultimate pit stop, Piston Pundit. March 2026 is pushing Europe back into an energy crunch, but this time, the real impact is hitting its industrial backbone. Gas prices are surging again after disruptions near the Strait of Hormuz and LNG supply constraints, just as storage levels enter a weaker refill season. Meanwhile, China has been quietly stockpiling crude and securing cheaper supply lines, giving its manufacturing sector a strategic cushion. For automakers, suppliers, and heavy industry, this is no longer just about energy costs. It's about competitiveness, production, stability, and who can keep their factories running when volatility strikes. Industrial shockwave. Energy surge crushes Europe's manufacturing core. Europe isn't in full-blown crisis mode like 2022, but the damage is already spreading across its industrial base. Gas prices, particularly Dutch TTF, have surged past €50 per megawatt-hour, and because gas still sets the marginal electricity price, power costs are rising alongside it. Even with renewables expanding, the system remains tied to fossil fuel volatility. For the automotive sector, this creates a chain reaction. Steel, aluminum, glass, and chemical production, all critical inputs become more expensive, pushing costs downstream into assembly plants and suppliers. It's like feeding inconsistent fuel into a precision-tuned engine. Efficiency drops, and performance suffers. Even manufacturers not directly buying gas feel the hit through electricity bills, logistics costs, and supplier pricing pressure. But rising costs are only part of the story. Europe's deeper vulnerability lies in its limited safety buffers. Structural weakness exposed, low gas reserves and LNG risks explode. Europe entered this crisis with thinner safety margins than expected. Storage levels were already low, with key economies like Germany and France sitting near critical thresholds, making refilling both urgent and expensive. Rising summer prices have also reduced incentives to rebuild reserves quickly, signaling prolonged tightness in the market. At the same time, Europe's reliance on flexible LNG imports leaves it exposed to global competition. With the United States supplying a large share of LNG, any shift in cargo flows, especially toward higher-paying Asian markets, can drive prices even higher. Add in the ongoing phase-out of Russian gas, and Europe now faces a difficult balancing act, securing supply without affordable long-term stability, leaving its industrial sector increasingly vulnerable. And while Europe struggles with real-time pricing pressures, another global player is operating with a very different playbook. Before we go deeper, do us a quick favor, hit that like and subscribe button. It really helps us bring more in-depth automotive insights like this to you. Now, let's shift gears and look at how China is handling the same storm. Strategic buffer gap. China stockpiles energy, while Europe pays premium. China has entered this crisis with a stronger buffer, but the situation is more complex than it first appears. Massive crude stockpiles and surplus supply give Beijing flexibility, allowing it to adjust refinery activity and preserve domestic stability. Instead of aggressively exporting, China is scaling back, processing, and prioritizing internal resilience. However, China is still heavily dependent on Gulf oil, meaning prolonged disruption could eventually create pressure. The difference lies in preparation. China accumulated reserves when prices were lower, giving it room to maneuver. Europe, on the other hand, remains tied to real-time market pricing for gas and electricity. For automakers, this gap is critical. Chinese manufacturers can absorb shocks more easily, while European producers face rising input costs with far less flexibility. But the consequences of this imbalance are now spreading deeper into Europe's industrial backbone. Industrial pressure rising. Steel, chemicals, fertilizer hit breaking point. The first cracks are now showing in industries Europe simply cannot afford to weaken. Energy-intensive sectors like steel, chemicals, and fertilizer are seeing costs surge, with some firms reporting massive spikes in gas bills. These aren't isolated cases, they're early warning signals. For automakers, this is critical. Chemicals feed into plastics, coatings, and battery materials, while steel and metals form the backbone of vehicle structures and powertrain components. When these upstream sectors get squeezed, the entire production chain feels it. Add rising fertilizer costs into the mix, and food inflation follows, pushing household budgets tighter. That directly impacts car demand. When energy and food costs climb together, consumers delay big purchases, leaving automakers facing weaker demand and rising production costs at the same time. And just as industry begins to feel the strain, policymakers are now forced into increasingly difficult decisions. Policy crossroads tightens, Europe trapped between subsidies and stability. Europe's policymakers are now stuck in a familiar but more difficult position. After spending hundreds of billions to shield consumers during the last crisis, governments are reluctant to repeat broad subsidies. But targeted support is slower and harder to deploy, especially in a rapidly shifting market. At the same time, doing nothing isn't an option. Intervention risks are rising again, ranging from subsidies to price caps and emergency market adjustments. That opens the door to fragmented national responses, where each country prioritizes its own industries. For the automotive sector, this uncertainty is toxic. Car makers can adapt to high costs or strict regulations, but not both changing unpredictably. When energy pricing, subsidies, and supply chains remain unstable, investment decisions start shifting elsewhere, accelerating Europe's long-term competitiveness risk. Which brings us to the bigger picture. This isn't just a crisis, it's a structural shift. Strategic reset underway. Energy security becomes industrial survival strategy. The bigger shift unfolding here is structural. Energy policy is no longer just about emissions, it's about industrial survival. European leadership is now openly acknowledging past missteps, including reduced reliance on stable baseload power like nuclear, which left the system more exposed to volatile imports. Now, energy security is moving back to the center of strategy. Nuclear, grid upgrades, storage systems, and renewable expansion are all being reconsidered not just for sustainability, but for stability. For the automotive industry, this is decisive. Vehicle manufacturing, whether it's EV batteries, aluminum casting, or hydrogen systems, depends on consistent, affordable electricity. In today's landscape, reliable power acts like a hidden subsidy. Regions that secure it gain a massive advantage in attracting factories, suppliers, and long-term investment. And that leads directly to the final verdict, what this all means for Europe's automotive future. Verdict: energy crisis threatens Europe's auto industry future. So here's the bottom line. Europe may not be facing a full repeat of the 2022 crisis, but this moment could be even more consequential. The real issue isn't just higher gas prices, it's the exposure of deeper industrial vulnerabilities. While China benefits from strategic reserves and the United States leverages domestic energy strength, Europe is still navigating volatility with limited flexibility. For the automotive world, this is the real takeaway. If energy remains unstable and expensive, production costs rise, margins shrink, and investment starts flowing elsewhere. Once supply chains relocate, they rarely come back easily. Now, we want to hear from you. Do you think Europe can rebuild its energy stability before losing more factories? Will automakers start shifting production permanently outside Europe? And how do you see energy policy shaping the future of EV manufacturing? Drop your thoughts in the comments below. If you found this breakdown valuable, make sure to subscribe to Piston Pundit and stay updated on the latest shifts shaping the global auto industry. Thanks for watching and see you next time. You can now check out any of the videos on the screen, there's plenty more to explore.